In this video, I'm going to be talking about paying your taxes with your life insurance policy. Now, to start, I'm going to break down what type of taxes I'm talking about, because of course there's many taxes to be paid, and then I'm going to break down what type of life insurance policies that I'm talking about using to pay off these taxes. The first type of tax I'll be talking about are your personal and corporate income taxes. Now, these are taxes that can be owed every single year, assuming you have some sort of income. I'll also be talking about your capital gains taxes, and these could be triggered with real estate, with stock portfolios. If you have a rental property or a family cottage or a vacation home that you purchased for less than what you've sold it for, that could trigger capital gains. You may have a stock portfolio where whatever you've invested, it's grown, and you make a sale, you sell that stock. There could be capital gains there as well. So I'll be talking about those types of taxes secondly. And then lastly, I'll be talking about taxes owed in your estate after you pass away. We'll call them estate taxes for short. Now, what type of life insurance can pay your taxes? It seems kind of funny to say that. Well, I'm not talking about term life insurance. Term life insurance is a perfect product for a perfect fit, but someone has to pass away for the payout to happen. There's no living benefit to a term life insurance policy. What I am talking about is what's called a tax-exempt whole life insurance policy. Now, these life insurance policies, yes, they still come with the life insurance. It's permanent life insurance. It lasts forever. It's paid off usually after a certain amount of years. But with these policies come a living benefit. And the living benefit is typically called the cash value. It's the investment part of these insurance policies. So with these type of policies, yes, there is a living benefit, and the living benefit can potentially be used to pay off your taxes. So if I were to reference back to the first type of tax I was talking about, your personal and corporate income taxes, yes, in theory, you can use the cash value to pay for these taxes. So is it ideal necessarily to be borrowing from your life insurance policy to pay for your personal income taxes or your corporate taxes? Not necessarily. I'm not encouraging it, but it is a fallback. It's a safety net. Especially as business owners, sometimes taxes can creep up on you. You don't realize how much you may owe. And at the end of the year, if there's a pretty large tax bill and you don't have the actual cash in your bank to pay for it, using your life insurance, the cash value in your life insurance to help pay for those taxes, I mean, it's not a bad idea. It's not going to be the first person in the world that has relied on a line of credit or some sort of a loan to pay the taxes. So do I encourage it? No. Is it a very good safety net to have in case something comes up? Absolutely. Now, the second type of tax, capital gains tax, kind of same thing. So if you're selling a property while you're alive and there's a capital gain tax to be paid, yes, you could certainly use the cash value in your life insurance policy to pay that capital gain tax. Now, on the end game, and when you pass away, let's say you had a secondary property. You bought a rental property 30 years ago for a lot less than what it's worth today. There's going to be a capital gain. Instead of using the cash value to pay for that capital gain, the life insurance death benefit could and probably should pay for that capital gain tax. So if there's $500,000 in taxes owed and your life insurance policy is for a couple million, you could in theory use $500,000 of that to pay the capital gains tax, and then that property is able to stay in your family for future generations. You're able to pass it down to your kids, grandkids, etc. So the tax-exempt whole life insurance policy is a bit of a twofold product when it comes to capital gains taxes. Yes, you can pay the capital gains tax while you're alive if you trigger a stock portfolio you sell and there's capital gains taxes to be paid, or rental property, etc. You can use the cash value while you're alive, but you can also use the death benefit after you pass away to pay the capital gains taxes if you die with a pretty big stock portfolio or a pretty big real estate empire. Now, lastly, the estate taxes. So this is most likely going to be your biggest tax bill you'll ever face, and it's actually the moment you pass away. You're not even going to be alive to see how big of a tax bill this is going to be, but I can assure you, the wealthier you are, the bigger this tax bill is going to be. So again, in this scenario, the cash value is not necessarily going to help you. It's going to be the death benefit that is going to pay off these estate taxes. Now, if someone were to owe, I'll use $1 million as an example. Based on all your assets, you have an RSP, you have, or maybe it's converted to a RIF by the time you pass away, you have a stock portfolio, you have a corporation, you have rental properties, a family cottage, there's capital gains and other taxes to be paid amongst all these assets. If this adds up to $1 million, before you die, hopefully you plan for how to come up with that $1 million in the cheapest manner possible. Because this tax bill is inevitable, it's not going away. The CRA is going to say, hey, listen, you owe me $1 million, we're not going to settle the estate, or we may go after some of the direct beneficiaries. It could get pretty ugly, and it's not a scenario you want to put your family through, having to come up with the liquidity the estate needs if there's a big tax bill owed. So if you went through your options and you talked about selling some properties to have the liquidity to pay these taxes, sure, that's an option, but I don't know if you want your family being forced to sell properties after you pass away. If you had that cash, I would say, why don't we take a fraction of it and put that towards a tax-exempt whole life insurance policy? Because if you're going to buy a life insurance policy that pays out $1 million when you pass away, it's not going to nearly cost you $1 million in premiums, or else that would make no sense. The point of life insurance is buying a future amount of money at a significant discount today. So you put in a little bit today to get a lot more in the future. So take a small amount of that cash, put it towards the policy, save the rest of the cash and spend it during your lifetime. If you had that $1 million and say you had to put in a third of that into a life insurance policy, dripped over 5 or 10 or 20 years. So it's not just like writing a check for $300,000 in year one. You could spread that pretty fairly over X amount of years. The difference you can keep and spend during your lifetime. So go take family vacations, go buy more assets, go have fun, a better retirement. You're maximizing your dollars and not forcing yourself to have to keep an absurd amount of money aside your whole life and never spend. It's highly unrealistic. Something's going to come up. You're going to dip into that money, and your estate may face a liquidity shortage, which if you've ever been an executor on someone else's estate, it's a very big problem to have. So to summarize, there are many types of taxes we pay, and there are commonly, two forms of life insurance. There's term and there's permanent. The permanent life insurance, whole life insurance, is an option to pay some of your taxes, whether they're personal and corporate income tax, capital gains taxes, or estate taxes. You can utilize the cash value, which is the living benefits, the investment part of a whole life policy, or you could potentially wait and use the death benefit to pay off some of these taxes as well. Thanks for watching.